If you're brand new to trading, guys, these terminology definitions may help. Hey guys, so quick video on some that have just come to my mind about definitions, some kind of normal ones that you use in day to day, some slang, and some other bits and pieces that are nicknames for markets. All right, so let's go. And by the way, I appreciate your support. If you're new here, consider subscribing to the channel for more videos on trading psychology, setup strategies, all that kind of good stuff that we need to become better traders. And before I finish these, if you've got any that I haven't mentioned that you know of, comments in the comment section below. Let's go. Okay, so the kind of normal ones, if you like, we've got long and short. Long is basically when you're buying something with the expectation that it's going to go higher. Short is basically something when you are selling something with the expectation of it to go lower, something that you don't own, that you're going to buy it back later. So in other words, you don't own the asset, you're selling it, or you're betting, if you're spread betting on it moving to the downside, and then you're closing the position by buying it back later. I've done a video where I've gone into deep context about how that works from an operational perspective, but fundamentally you're betting on a downside move when you're short, you're betting on upside move when you're long. Okay, so bid and offer. So bid is basically on the one side of the order book where you have a limit order in and you're expecting to buy something that's not yet achieved that price. Imagine if the price is currently 100 and you've got an order in to buy at 98, that would be a resting bid because you want the market to come down to 98 to fill you. On the other side of the order book, you've got your offer or your ask. Depends, sometimes in the UK it's called the offer, sometimes in the US it's called the ask, but it's interchangeable. The idea is same kind of thing. If you want to sell something at 102 that's currently 100, you would put a sell order into the exchange at 102, and when the market comes up and hits it, that's when it would fill you. So that's when you're sitting on the if it's the ask side of the order book or the bid side of the order book. Theoretically speaking though, the bid and the offer are technically the best bid and the best offer or the best ask are the levels where the best possible price you can buy at and the best possible price you can sell at, and the difference between the two is the spread. So if the market's currently trading at 101 to 102, the best bid would be 101, the best ask would be 102, but theoretically all of those orders in the exchange would be the ask side, and all those orders in the exchange below 101 would be the bid side. So bid, ask, or ask and offer, depending on the way you're looking at it. Okay, so size. What does size mean? So a couple of things here. Size is the size of your position. You also have things like I'm trading size, which would be a slang terminology for trading what's perceived to be big size. That guy swings around a big size, means that effectively he's trading a decent number of contracts or a decent size position or a big position relative to people's expectancy. So that's the size of your order. Filled or fills. Basically, filled means my order has been filled. I had it, I sent it out there, the order went through and it got filled. Fills means I've multiple of filled if you like. So one would be I've been filled on the order. I've had 6 fills would be I've been filled 1, 2, 3, 4, 5, 6 times, and that may be partially, so I've only had 6 fills out of 8 or whatever it may be. So that's the way you approach that one. Number 2 is vol. Whatever that number is vol. So vol stands for either, depending on where you're talking about this, volume or volatility. Now, if you're in the options community, nearly always it's going to be volatility. If you're perhaps someone who's trading a community, maybe futures or stocks who aren't even involved in options, they might say vol and they'd be relating to volume traded during a specific time frame. So volume or volatility, interchangeable. Technically speaking, vol would probably be volatility. Most people use volume, but I have heard of people use vol when they're talking about volume as well. So it depends on which sort of kind of area or group of people you're in when you're talking about that. Position means where are you positioned now? What's your position? Are you long? Are you short? What's the size? What's the entry? What's the exit? Do you have a position? Means do you actually even have a position in the market? Are you positioned? I.e., what is your, are you long? Are you short? Do you have stock? Do you have this asset? It's what is your position? I'm flat. I don't have anything. I'm long. I'm short. Okay, scale. Scale basically means you're adding to the position as it goes in your favor or against you. So your scaling in could be as the market goes down, you're adding. As the market goes in your favor, you're adding as it goes up. Sometimes they're interchangeable with scale and pyramid. Pyramid is more like adding as the position goes in your favor. Scaling out will be scaling out of your position in multiple positions. All right, so liquid thick and thin. So liquidity is how, I'm just going to use it straight away, thick or thin the order book is. So really that means how many orders are stacked in the order book. A thick market with thick liquidity means that there's lots of orders there, lots of volume to trade, so more people can get involved and get better prices. A thin order book will be when there's fewer orders in the book on the bid and the offer, means that a large size will move the market dramatically. We see the order book go thin before things like non-farm payrolls. If you look at, say, the S&P 500 order book before non-farm payrolls, it starts to go thinner because people start to pull their orders out of the order book, so liquidity is drying up, it's getting thin. Whereas when we're talking maybe towards the end of the close and we've got lots of orders coming in and there's lots of volume, then the order book gets thick. It gets thick with orders and resting orders, and people want to buy, people want to sell. All right, so let's look at some of the slang terminology here. Dead cat bounce. Dead cat bounce is when a price is heading down to the downside, it bounces up and it really is a dead cat. In other words, it's just going to fall down again. It's dead. The stock is dead. The market is dead. It's not to be, people get sucked into buying a dead cat bounce incorrectly when really it's just a small bounce when it's going to continue on its trajectory to the downside. Face ripper, I love this one. Face ripper is generally used for a rally that is really hurting shorts. Now, it can be used interchangeable with people who rally just generally going long, but generally speaking, it's used when shorts are wrong and the market is ripping to the upside. So it's ripping, it's a face ripper. You know, you're short, the market is going higher and higher, day after day after day, it's ripping the faces off shorts. Fat finger, that's basically the terminology when someone presses an order or fills an order they weren't expecting to. So really it means that, you know, you're clumsy and you're pressing the order, you've got a fat finger and you meant to press buy at 100 and you press buy at 1,000 instead. You ended up moving the market. Now for us, it's not going to do much. We might end up putting a market ordering or selling instead of buying, those kind of minor errors. But there are circumstances, I've done a video on this, where people have had big margins big unrestricted access to exchanges and have had fat fingers, and it's cost them millions because they've put in orders that were perhaps the wrong way around. They meant to buy 100 at 10, instead they bought 1,000 at 10 or whatever. You get the point. The idea is you're putting an order incorrectly. Bagholder is somebody who's buying a stock at the highs and is still holding the bag when it's at lows. So stock's been pumped up, lots of euphoria around it, people are buying it expecting it's going to go higher, and then all the euphoria dies off, the stock starts to push down and you're left holding the bag because you bought right at the highs. That's a bagholder. Ramp is generally something that is, if the market's ramped up, it means that it's been pushed to the upside. There's been a rally, there's been an aggressive rally that's pushed things up. All right, bottom picking is, as you would expect, a market that is pushing to the downside, somebody who is buying as the market is coming down. Generally in a stock's perspective, so you're stock picking, market's coming down and you're saying, oh, I think that's the bottom, and it's called bottom picking. And generally speaking, obviously there's people who do make money out of that, but if you've got to be very, very good with your timing, very good about spotting that, because generally speaking, you're going to get pushed even lower before it turns around. What have we got? Catching a falling knife. Catching a falling knife, pretty much as it says it is, guys, a knife spinning through the air. If you catch it right, it's great, but the chances are you're going to catch the blade. So the same kind of thing with this bottom picking, not quite the same, but the idea is this is more of a derogatory term of, oh, you're trying to catch a falling knife. The market's hammering to the downside and you're there trying to go long. That's catching a falling knife. If you get it right, then it's great, but the chance of getting it right is slim. If you get it wrong, you get slashed because the market is still in momentum, full bear mode, and you're there trying to catch it. Shake the tree, not used so much anymore, but perhaps going back years, we have market makers operating solely in specifically UK shares. They would often, if the market was ramping up, they would often adjust the bids and the offers to make it appear weak, and the terminology or phraseology that went around was this was shaking the tree. In other words, people who were long, it was almost like the metaphor for the market makers shaking a tree to try and get some buyers to sell so they could kind of square off the books before they kind of push it back up again based on the supply demand. So it's shaking out or supposedly weak buyers. Pump and dump is a terminology or phrase used when there would be a pump, which is basically lots of PR around a stock. It'd be email newsletters, it would be advertising, it would be spreading things around forums, it would be this and that. The SEC have cracked down on this kind of stuff, but it still kind of goes on. Ultimately, tips, newsletters, that stuff, creating a hype over it, and then the person who created that hype hype, or the person who's working for that person who created that hype would then dump all their stock, all their holdings into that euphoria from the public. And so it's a pump it up, make it sound great, get all the public involved in it, which causes the price to go higher, and then dump your stock into that illegal act. So tank would be if the market is just falling through the floor, falling down aggressively, that would be the market's tanking or tank. Multi-bagger would be multiple percentages of your profits. So you bought something at 10, a multi-bagger would be, you'd be looking to exit at 30, 40, 50, 60, 100, 120 in multi-bagger. And quite often people say 10 bagger as well, so something at 10 times what they paid. Cable is GBP USD on the Forex side of things. Loonie is the Canadian dollar, and Swissy is the Swiss franc. There we go. I've run through some ones for you guys, some terminology. If you've got any, stick them in the comment section below that I've missed. I'm sure I have, but traders are pretty good at making up some slang stuff, right? See you next one. Take care. Bye bye.